Food Trail with Shankar Sharma. Well, Shankar and me caught up in Kolaba. I mean, for those who don't live in Mumbai, that's the old Mumbai. It's got lots of eateries. And for a change, we spoke about food, life, stocks, and some ideas. But, you know, the narrative of the conversation was centered around his favorite cuisine, the course of his life, and which are the small caps which could potentially become large cap stocks.
Which are his favorite small caps?
He's hinted at them.
That's a good one. Okay, let's hear him out.
The only thing I envy about Warren Buffett, trust me, the only one thing, okay, is his genetics. The eating that crap, trash that he has eaten for so many decades, drinking sugary Coke and eating burgers. And he is, you know,
87,
and he is batting like he can go on forever. You know, trust me, that really makes me completely envious. Not his wealth or his achievement. That's okay, we can all make a lot of money in context. But to live eating burgers and Coke and live to be 90 or whatever, 95, 100, God knows where he ends up with.
So how would you connect markets and food?
Well, we have to work very hard to support all this eating out, right? So Monday to Friday, you know, that's what I spend a lot of time doing. To find money to spend on Saturday and Sunday.
You know, there are 6,000 listed stocks, and a stock picker will be able to identify those 10, 15, maybe 50 stocks which would change the course of your life. That's not the case with food. It's easy to choose, you can be experimental, but when it comes to markets, you really have to go in depth, analyze, study.
It's the same in food, you have to keep an open mind. In markets too, keep an open mind. I mean, that's what I always say, that you know, the biggest pitfalls that as investors I'm equally prey to that. It's not that I have some special skill that makes me go away from that. We all get sort of straight-jacketed in our thinking and in our approaches and philosophy. While in markets, something works for some time, but nothing works all the time. So you either have growth or value or momentum, or you have to move with the times. So the one thing I really want to always keep doing is to remain flexible, not to become hardened in my approach.
A lot of people say that, you know, habits don't change, and if I can use the Hindi terminology, kutte ki dum kabhi seedhi nahi hoti hai. Do you think we should not look at past as the indicator of future performance for markets, for promoters, for businesses?
By that token, you shouldn't have bought Amazon or Apple. Both of them had terrible first innings of their lives. Terrible. I mean, Steve Jobs left Apple in tatters, came back, it was still in tatters. 7 years after he had rejoined, it was still in tatters. By that token, you should have never bought Apple. Okay? Jeff Bezos started in 96. By 2002 or 3, the company was virtually, you know, bankrupt. I mean, just because they are sitting in the US, we will say, no, they don't have to answer to the same rules. Fact is that they also messed up in the first part. They came back very strongly. You would have been dumb not to have taken a look at them again. And in India, there are many examples of companies turning around. I mean, Jindal's a good example. Lupin is a very good example. I mean, all these companies are considered untouchables in the early part of the 2000s. Go back in time. You know,
Marwadi companies.
Memories blur. We forget things. We start to ascribe the last data point as indicator of whether he's a god or a devil. And I say that's nonsensical. Go back and see in the first phase of the Jindal's life, they were not considered top-notch management. Lupins were not considered respectable at all by any standards. You know, Tata's, nobody gave a chance in Titan that, you know, they don't know anything about the consumer business. I mean, think about it, which consumer businesses have the Tatas done? Nothing, zero. When they started Titan and started making watches, and I know their project very well in the 90s, we never used to, you know, believe that Tatas could ever do anything sensible in the mass consumer market. Selling LCVs is different. I mean, they couldn't even sell cars properly, right?
Titan had a problem of existence.
Exactly right. For nearly 10 years of its existence. Then suddenly one fine day it came back. So you have to have an open mind. Companies are not static organisms. You know, they change, they morph.
How do you see your life evolving in next 10 years? You know, you've taken some very big steps. You know, when you were in 20s, you decided to move into the stockbroking business.
Yeah.
Then came this entire, TMT opportunity and the TMT bubble. You were right at the ahead of the curve when you bought stocks like HFCL, ahead of the curve when you also came on public platforms and said, look, there's a bubble in making. The boom and the bust of 2008 also, you were right ahead of the curve. So these are market factors which have changed the course of your life. How do you think, what is the next course of your life now?
The next course of my life is, obviously investing is close to heart. And I find that there is nothing in this world which is more liberating or more relaxing than managing your own money. Because the pressures there are only internal. You don't have to justify transactions to anybody. You don't have to explain to anybody why something has worked, why it's not worked, etc., etc. And you can live life at your own terms. And I think ultimately every person's objective of life is that you should be able to live life at your own terms. And I think investing gives you that. At the same time, I think every single day, I end up learning something I didn't know yesterday in terms of diversity of companies or promoters. And of course, the other big change that I now see, and hopefully it will accentuate, is that now after having seen 25, 30 years of different businesses, the mistakes companies made, you're better able to guide the companies where you invest in. Because, our model of investing is not that you buy something and then, because typically we'll never buy great managements. Our attempt is to make them somewhat great or somewhat good. So therefore, there's a lot of mentoring involved, a lot of discussion involved. It's important for them not to make huge mistakes. And therein your experience helps, because you have data banks which the promoter typically won't have. He might be an engineer, an MBA, or might have done something for 5-10 years. But the long-term histories that you have seen, experienced, profited from or lost from, that they will not have.
So have you made any large investments in the last 6 months?
No, I'm looking at a lot, but some of them are close to being done.
So what is stopping you? Price or capital?
No, it's just understanding the companies. I mean, we take time over investing. So, typically we are not like, we'll meet somebody today. There's a management that came to meet us the other day, and it's a NCLT kind of situation. And you get 270 days in that. And they said, would you be interested in buying out the company or something of that sort? When I said, look, it'll take us time to understand, first of all, what the problem was. And if at all we end up doing it, it's going to take like 8-9 months for us to figure it out. I mean, it's not a quick decision.
So, there's some classic dishes which you would say are all-time favorite. There are some dishes where you would say I'm only experimental. And there are some dishes where you have decided that, look, I like them, but I don't like the price of them. So let's talk about markets. How would you break the market in these categories? What would you say is a classic all-time business? What would you say is just a appetizer, more like I'm going to test it, not marry that company or that business? And what you like, but you don't like the price?
I mean, to answer the third question first, I mean, obviously companies like Lever and all, you cannot not like. The consumer business, what Warren Buffett has made his name, we understand the logic, but somehow in India, the pricing has always been something I have never been able to rationalize or figure out. I've never owned a single share of Hindustan Lever or Colgate or anything of that sort. Many people have, they've profited handsomely, but we've never found guts to buy something at 60, 80 times earnings. Now they have corrected a bit, but still, they're still very pricey. Infrastructure is something which is the second question. Not something I like, but I just think the first phase of companies got over. The second phase of companies, the road builders, hopefully, would have learned the lessons. So it's not a great business, but I think it's a good time. And the first ones, of course, are, your autos and stuff like that, because I've always believed in, this goes back nearly a decade and a half, that it's not difficult. I mean, India under-penetrated in two-wheelers, even more so under-penetrated in four-wheelers. I remember having done a piece in 2008 or something, where I think car ownership was like 2% of the population or something like that. I mean, it's going to go to 10%, right? That's enough. That's enough to make several times your money. I mean, and how many players were there anyway? They're just a handful of 3-4 players. It's not that foreign company is about to come. Everybody who could come is already here, and one guy is hanging on to a 50% market share. It didn't take much to figure it out. So, two-wheelers we've liked, Bajaj Auto we've liked for decades now. I've said it publicly, I consider the best management in India, because not just autos, they've proven themselves in financial services.
But they missed on scooters.
I think that was a huge mistake, and I think for all the good work that Rajiv Bajaj has done, sometimes you can be too creative, and I think that was a bit of excessive, creativity. Even when, and I'm not saying it is the benefit of hindsight, even when they did it, I was of the view that I think this is not a smart move.
You believe in the power of cycles, and we've been in this earnings downtrend for a while now. Why is the cycle not picking up?
Well, I mean, that's a little bit of a trickery here, because broadly the cycle has not picked up, but the sectors that have been doing well, like autos or banks, etc., their numbers have been good, and if you see, those are the very stocks that are doing well. But you clearly don't expect big embattled debt-ridden companies to do well. So you have the ADAC group, which has obviously been very, very weighed down by debt without any catalyst of earnings. I mean, that's not going to revive. I mean, that's very clear. But companies which didn't have debt, you have the auto pack, they're not having debt at all. They have been doing very well over the years, or consumers for that matter. So earnings growth is very patchy. Okay, but when you take it in an overall sense, it averages out to almost nothing. But sectorally, some sectors have had very good earnings growth.
So just to wrap it up, and I'm going to focus on only food after that.
Okay.
We like to think that you should find good ideas, cheeky ideas, try to find the next multi-bagger idea. That's what the endeavor is. That's what the sense which we get when we talk to our viewers, and the kind of feedback we get from our viewers. That was agda bada idea nikalo. But you think in India, just keep it simple, buy autos, some consumer names, buy these stocks when markets are bad, and just sit tight?
No, I mean, that's for, I mean, like I always say that
for an average investor,
what might be good for me or relevant for me is not necessarily relevant for somebody who is not doing it full time. Not possible. But I've maintained the small caps look great for 3-4 years, and I continue to maintain that. I mean, I think even now, there's so many, and people talk about valuation fraud in small caps, so that they've run up. Yeah, they've run up, but earnings growth in some of them is just off the charts, and now they're trading like 10, 12, 15 times 1 year out earnings. I mean, rather current year's earnings.
After the sell-off.
After the sell-off, I mean, that's not bad at all. And my view is this, and I've said this in a recent interview to a paper, which 2008 was very good data. If you're a student of markets, that was brilliant data. A year which I don't think we are ever going to see again, 65% down market. In that market also, the only stocks that did worse than the market were companies with debt. If you went to the companies which were fundamentally strong, then they fell only some 30-odd%, and they didn't have debt. Okay, and the worst of them, like some M&M, which didn't have debt but has some rural, etc., only fell 50%. Imagine in a cataclysmic year, good stocks fall tops of 30, 35, 40%. Therefore, and we have seen good stocks fall 40% in the last, let's say, 4-5 months. That's the bottom. That is the bottom. As long as there is no debt on the balance sheet, good stock, good earnings outlook, or at least intact earnings outlook, and then they are down 30-35%. It's a no-brainer, because even in 2008 they didn't fall more than that.
So thumb rule is buy companies which have no debt and where the selling is about 25-30%.
And earnings outlook is intact.
Of course, and the promoter has to be decent enough, or has to be.
Yeah, I mean, obviously those hygiene checks
clear.
have to be there, right? But I'm saying if those have fallen in a market correction 30%, I think it's a no-brainer.
And he feels that autos and banks and private banks, if you take out of the equation, frankly, we've not had any significant or structural trends in the market.